very warm welcome to all the panelists. We have an amazing panel. So, right from early stage stalwart like Arpit from Blume to venture stage Sumit, Filter Capital, to venture debt, Eklavya, Recur, Akshat, growth stage, and finally Nidhi from Khaitan, who ties it all together and makes sure that the paperwork is in order and everybody is protected. It's amazing. I don't think we set out to create such a diverse gradient panel which scans all stage, but so glad that it panned out that way. So Arpit, first question is for you. We'll start with early stage. In the current market, I think everybody's been talking about dry powder, and all numbers, right, from 17 billion to 30 billion across stages. Early stage still seems to be bucking the trend. We are seeing a lot of early stage deals. Numbers are showing it's almost 1.7 times higher than last year. What do you think is happening? Why is the early stage pipe not moving to venture and growth? And you would have many portfolio companies, some successful. Would love to hear.
Early stage is happening because early stage has money. Did you get this? Early stage is happening because early stage has money. There are people who are there. There are a lot of early stage investors, and early stage investors have raised a lot of money. In the last 3 years, our ecosystem has grown by maybe 300 different firms. And as a consequence, all this money has to be deployed in seed stage and pre-series and series A stage. The challenge is that you cannot become what Sumit does if you are a first-time investor. If you're a first-time fund manager, you have to have track record. Otherwise, you can't raise a large enough fund which can justify the strategy that he plays. So only when some of us will graduate into, once we have seen 2-3 cycles, then we can graduate into later stages. So what you're seeing at early stage is really that there is money available and people are willing to deploy this via fund managers. So yeah, that's the answer.
Any advice for founders here? There are a lot of early stage founders in the room on how do they cross the chasm and
I think the only thing that works, Apurva, as you know, is persistence. There is no good answers to anything in a startup environment, because if you had the answer, you wouldn't start up. It wouldn't be anything new. The only way to go forward is to be at it, be persistent, attend internet day and everything else that Delhi does, because they are good people and they are able to help you in many ways. And keep expanding that funnel. And if you were to get funded, if you are good enough today, rest assured, there is money available. And if you are not able to raise after a lot of effort, it is possible that venture capital is not for you. And that is good enough answer to go forward.
Excellent. Nidhi, you know, we've also had some issues in the startup ecosystem with some companies shuttering because of all kinds of corporate governance issues. Do you see now investor protections in term sheets being very, very aggressive? And is the balance of power moving too far towards capital allocators?
I think with all questions, I don't think there's a one-size-fits-all response to this that fits. I broadly agree with everything Arpit did say, that good assets still do have good capital available, not just in terms of valuation, but also in terms of the terms and the rights package, right? But if we were to all zoom out and try to take a macro view on this, I think I would probably agree with your opening statement that I do think there is a bit of a shift happening in favor of, the balance of power is tilting towards the capital. Some would probably say in some instances disproportionately so, but Apurva, if you look at it historically, the pendulum swings, right? During hot markets, I think founders had the edge in 2021. So it's a bit like it's swinging back in favor of capital. The question really is this normalizing, or is this the start of a longer-term rebalancing? But I mean, in the context of that, I would say there are some asks that I am seeing being made now, which are probably more aggressive or a function of the market environment today for fundraising. one of the things we hear of more commonly now is more seeking more than a 1x LP protection. You know, earlier it was almost par for the course that it is 1x and that's the deal. But we see the ask for more than 1x coming up more often now. We're also seeing some, you know, at some early to mid-stage term sheets looking for, you know, revesting of already vested founder stock. So, you know, resetting that clock a little bit, which is again a quirk of the Indian market in some ways. And the last I would say that I'm seeing again come up a lot is when you're looking to claw back in bad lever scenarios, founder options or stock that have vested. The bad lever now is also being looked at as failure to meet performance, you know, goals or funding milestones, which ordinarily is linked to things within a founder's control, but now we're seeing that sort of broaden a little bit. So I would say net-net, I think the market is seeing some moves in terms of investors being hyper-focused on downside protection. And I think there is a little bit of a sentiment that this moves away from protection towards the zone of control.
Yeah, I think that's a very slippery slope. Yeah, investors controlling the company. Eklavya, you know, you almost created the revenue-based financing market in India. You were one of the really early adopters. Are you seeing founders really understand the role which debt plays? Is there like a wide understanding? And are you seeing VCs also encouraging founders to mix the equity round with debt? And
No, I think that's a very, very important question. So when we started like 3 years back, I think the situation was kind of different. But things have changed. Like people are more aware of debt options, but still long way to go. Today, I think the Indian founders are using Apurva debt they think that when they are not able to raise equity, maybe they come to debt, which is not the right way to look at it. So debt is not for survival, right? Like, so if you use debt money for survival, you are digging, hole for yourself. So if your metrics are right, if your, unit economics is right, if your margins are better, debt is a great tool for growth capital and equity is a great tool for experimentation capital. So both of them historically, whether it's a startup, SME, large companies have leveraged, and mixed debt and equity in the right way, which I think young startups are still getting warm to. But if you don't have, a business model proven or a unit economic set, and if you go for debt, or if you have a runway of 3 months and then said that will solve my situation, I think that is where a lot of founders still come for it, which is a wrong option. So long way to go, but I think things are still better and people are more aware of different debt options. So our VCs, I think a lot of VCs portfolio, we work with a lot of VC portfolio companies, which are actually making the founders aware that how to actually calibrate and use, debt alongside equity.
Sumit, is India producing enough growth companies which are compounding at scale and hitting escape velocity? Or is the market just a fight for a few good deals? What are you seeing in the market nowadays?
Yeah, as Arpit rightly said, there is massive amount of capital that's going into the venture space. And that is creating this big startup ecosystem in India. And we are a big beneficiary of that because they all have to raise further rounds and we started Series Bs and Cs. So we are meeting almost a company a day. And just to correct, Apurva, we are not a venture firm, we are a growth firm. So we only invest in 2 to 3 companies a year. So there are a lot of no's we have to say. From that perspective, you could argue that, yeah, the number of companies we think who can really cross the chasm and scale are just a tiny fraction. But if you look at it in totality, there are many more companies of high quality, of unique business models that have been built over the last decade. I can compare it to the early days of the e-commerce ecosystem when we were growth investors in my prior firm at Warburg Pincus, and there were very few companies of good quality at the scale that we started investing in. So obviously the ecosystem has expanded massively. And at some level, as growth investors, we shouldn't complain if there are companies which are not fully baked in at the time we come in. Because part of our job actually is to carry them forward and make them scalable and sustainable. And so as investors, we have to start shouldering the responsibility on behalf of the startup as well to say, these are the right ways to grow from here. And also put the right mindset in place for that company, because not every company grows in the same way. So every company will have a different growth strategy and you can't apply the same lens, and that is probably what's required in the market today.
Sumit, 365 opportunities, you're saying one a day. even if you take like 250 is like a very, very strong. What sectors are you seeing these companies in? Like, are there any sectors which are like over-indexed?
Yeah, I don't work 7 days a week, so 250 is the right number. Yeah, it is across sectors, and we are a growth investor with a tech lens. So we look at everything which is using technology to differentiate in the market. So we have a pretty broad canvas, and we are seeing opportunities across software. We're seeing a lot of opportunities in consumer, because a lot of new age consumer brands are being built, and there are a lot of venture firms that are helping them get started. And we're seeing some really interesting niche players coming out of the woodwork. We're seeing a lot of action in fintech, a lot of action in B2B, and definitely, interestingly, a lot of action in IT services, the traditional industry which historically has been bootstrapped and not raised venture money, but we're seeing a lot of venture action in IT services as well, almost to the extent that there could be wastage, unfortunately, if venture guys come too early in IT services, in my view, because they're fundamentally profitable businesses from day one. But yeah, the opportunities are across sectors.
Next is you, Akshat. So, Chrys Cap has seen many, many cycles. Almost 20 years now?
We just completed 25 years.
25 years, wow. So many, many cycles. What do you feel about the entry multiples right now? We've seen cycles where the entry multiples have been really high. And then recent past, we've seen listed companies really, I would not say melting down, but the stock correcting massively post-listing. And you would have companies which are about to list. So what do you feel about entry multiples now if they corrected in India at private equity stage?
I've been in the industry 15 years. The funny thing is I've never faced a moment when somebody said valuations are cheap. But valuations move in cycles. They're certainly cheap compared to what we saw a couple of years back. But that was a frenzy which I don't think is going to get repeated. And we don't want to overly anchor ourselves to discounts to those levels. And as any other private equity fund, we focus on long-term multiples. And when you look across sectors and compare them to long-term multiples, I would say you're closer to median levels, maybe a little bit higher. Different sectors may have their own nuances. But it's not, the only thing you can say safely is we're not in a crazy valuation environment. We're certainly not in a cheap valuation environment either. India in general has always had slightly elevated valuations compared to other geographies as well. Call it the risk premium that we get, call it the growth premium. But that's a challenge that investors have had to figure out a way to navigate, because you can't, it's very hard to build a sustainable engine looking at finding sort of value opportunities out of India.
Akshat, a follow-on question. India was the #1 IPO market last year. And this year, hopefully, again, it will be in top 3 globally. Are you seeing your cycles coming down, cycles to exit the deal coming down with more and more companies in your portfolio looking at IPOing, like faster exit times?
I think what has happened over the last couple of years, it was running joke that if you had a company that could go public, you take it public, which is great for exit. So there's good and bad to it. The good is, after a long time, capital markets has shown to be a sustainable way of creating liquidity for private capital, which I think is very encouraging for the ecosystem. But at the same time, it should drive some caution that when you hear statistics like India has been the biggest IPO market in the world, clearly there's more in it and there's a lot of enthusiasm in that, and that enthusiasm has to settle. We are seeing some of that settle already. The good thing is it's not crashed, which is what you always worry about. But the prudent thing is to watch out for the cycle sort of correcting and take solace from the fact that the IPO markets are maturing thanks to the domestic capital, thanks to the power of all the SIPs that we're seeing. And it can now safely be underwritten as a reasonable exit opportunity for a wider part of the portfolio than you could do it earlier. Earlier, it was just option value.
Arpit, one common refrain I was talking to a lot of founders at the breakfast table was that a lot of early stage investors are now behaving like Series A, Series B investors. They're looking at defensibility, moat, traction, and this is at a pre-seed seed stage. So
I read your question on email and I was thinking to myself, if someone is saying not right now, they are probably not hot enough for you. right? That's what it exactly means. A lot of early stage investors do tend to act like Series A investors, achakka lana, bring me 100K MOU, bring me 1 CR revenue, when they're doing 50 lakh investments, is only a function, it is not that they are not investing in other companies with inferior metrics. They are not investing in you because this is a way to say no. So this is a guarded, this is a disguised no in most cases. You know this, Apurva. Unfortunately, we have to resort to this. I wish I could say no to every entrepreneur who comes to me, which inevitably we do, as straight as we can. And we could give them real reasons why we don't like this particular company. And a lot of them could take it very personally, which is why we don't end up doing that. So yes, when you say people are saying, come and act like Series A investors, and Series A investors act like Series B investors, and Series B investors act like Series C investors, and the chain is continuing, and IPO investors, I don't know what they have started acting as. They have started acting as growth stage investors because sometimes they are very excited about companies more than public market. But yes, I think the answer is that it is mostly a disguised no. Also, the number of companies which are approaching them are too many, so they are also spoiled for choice. All of us are spoiled for choice at every stage, which is a great thing about the ecosystem today.
Nidhi, you represent both founders and investors, depending on the deal and transaction. Are there any blind spots which you're seeing which founders have when they're negotiating? Like, what's your advice to the founders here who are raising? What are you seeing them not looking at carefully? Is it liquidation preference? Is it drag along? Is it something else?
No, I think that's a great question and also an important one because in my experience, what founders get tripped up over are not the headline terms, but what's buried in the process.
Like the reserved matters in?
Potentially. Like, let's take, I think, some of the typical blind spots that I think catch founders by surprise after sort of agreeing to it at term sheet stage or even documentation stage, right? The big blind spot I hear about all the time is 1x LP seems fair, problem care. And then when you start reading the clause, you realize that a lot of times founders have not realized that they've given up participating preferred, for example. Or over multiple rounds, when you start agreeing to a stacked LP, what that could mean for the common equity holders, such as the founders, at the time of an exit, 100 million in exit, let's assume 100 million in exit, with stacked LP, potentially more than 1x LP in some instances, over multiple rounds could, lead to even a 70 million payout to your investors, leaving so little for the common. And so I think it's important for them to understand it's not just the 1x LP, but what is buried in the terms of that LP. I think that's one, more often than not, blind spot that we see. Another one that comes up a lot is, in the drag sale construct, where they're like, yeah, all of these protections are naturally required because they just want to be able to complete a sale. Again, what's the issue? Sounds fair to me, let's go ahead. But again, the way in which the drag sale could be structured may result in, sometimes founders and common not having the ability to participate proportionately in that sale. So you're taking everything off the top, but are you then proportionately ensuring it flows through to the shareholders that are getting dragged? So I think those are some of the, my big takeaway, if any, that I would leave with the founders here would be that, yes, a lot of these principles are well understood, but it's equally important to focus on the process and the whys and the buts and not just the headline terms.
If I may just add for 30 seconds, because as growth investors, we do sometimes see term sheets which are very, very investor friendly. And we are tempted to just write our name on top of that and continue in the gravy train. But actually, we are very conscious about putting the right set of terms at the stage we come in, because the founder has built the company to a certain extent and they deserve to have more power in the agreement. And a lot of times we delete the drag clause and we find other ways to secure an exit. And it's important because you don't want a sword on the head of a founder and then the founder starts thinking about exit rather than building the business the right way. So some level, the silver lining is even if you're signing up to onerous terms in the early stages, don't worry, if you scale up, you'll be able to wind back a lot of that when the growth stages come.
Eklavya, I have a question for you. What does Recur or RBF or venture debt firms like you look at beyond the obvious creditworthiness metrics? Like, what should the founders start keeping ready when they come to you?
No, I think very good question again, right? Like, so what we typically banks, NBFCs, institutions have done is more an asset financing. You know, they would look at your balance sheets rather than actual cash flow strengths. So I think true unit economics should be very strong, right? Like you need not be profitable when we are evaluating you for a new age startup. All of us understand, but your contribution margins, your unit economics, and should be just greater than cost of debt that you would get technically. It's as simple as that. If you are spending 100 rupees somewhere and if you can generate 150 rupees and your cost of debt is 120 rupees, you can scale infinitely using that. The hypothesis is that you know how to scale from 100 to 150 using that money. So some of the things like compliances, I think that teaches if you have been compliant in terms of which people take lightly in startups from a GST, you know, EPFO filings, or any other small legal cases, etc. All of that should be clean, your CIBIL scores, you know, because those are more hygienes and tell the way how you do financial discipline and prudence, along with the strong unit economics. If these two things are right, and don't wait for the last minute to come to raise debt, your runway should be at least greater than 6-9 months for you to able to sustain service that debt options. If you keep these 5 things in check, I think more often than not, people will get good debt terms for them to grow without diluting.
Sure. Akshat, will go back to you. What is the number of companies, new investment opportunities would somebody like Chrys be looking at in a year? Yeah, in a year, say.
Sorry, did you say in AI or in a
In
year?
a year, in a
In
year,
a year,
yeah.
okay. We'll typically, so we're a diversified fund. We'll usually do 4 to 5 deals in a year. And we typically sign maybe 150 to 200 NDAs, which is a good way of sort of gauging how many deals we're evaluating. So that's really the drop-off. I mean, our success rate in a year would be under 5%. And that also is aided by the fact that we are fairly diversified in the number of sectors we can look at. We don't always invest in the same sectors every year. We take macro views on different sectors. We sometimes go aggressive on certain sectors, stay back on others. But having been in the market for long, it just helps feed the top of the funnel well to allow us to take those bets sensibly.
How many of these would be tech-enabled or re-platforming to AI? And are you seeing tech play a larger part in?
So tech's been always one of the strongest sectors for Chrys Capital. I lead our enterprise tech vertical. So that would be IT services, BPO, and enterprise SaaS. We've also been increasingly focusing on consumer tech companies, new economy, internet companies. So the proportion of tech-enabled businesses in our portfolio has risen significantly. I think the last fund, maybe close to 50% would be that. Yes, of course, on a lighter note, these days hard to find a company that does not claim to be tech-enabled. Doesn't mean they are. Or AI-enabled these days, yes. But yes, truly tech-enabled is an increasing portion, and tech's becoming ubiquitous. It's hard to actually escape tech these days.
So Nidhi, you know, your firm also does a lot of growth transactions, and you still hear from some large companies which are trying to flip back to India that it's not very smooth. They would have thought it would have happened much faster because they're actually going to monetize in India. What do you think? So many of the speakers here are also from growth stage companies. What is the best practice? What are the 2-3 things they should start thinking 2-3 years before IPO as they think about moving back to India?
I think that's a great question. We've seen such a slew of companies headquartered outside India, but with India operating assets looking to come back. And I want to say there's a playbook, but each time some pages get added to that
Maybe
playbook.
Khaitan can do a playbook.
No, that would be, yeah. But I want to say that with each one of them, you start realizing there is a bit of a quirk. That quirk is fueled, fortunately or unfortunately, by a bit of regulatory uncertainty around what the regulator at that time thinks about that particular flip back in question. So So I think a couple of things is key. I think engagement with the regulator early on, and by regulator I mean we are all aware once you're flipping back, SEBI is going to have purview over the company. So engagement with the regulator, trying to assess what is the right manner in which you flip back. Not to be reactive, but to be proactive. We now have simplified this. We have the fast track merger for the flip backs. And it's actually truly fast track. A couple of them have come through. So we're looking at anything that used to take 6 to 9 months, come down to 45 to 60 days. So again, getting ahead of what that is like. And then I think a lot of engagement with your stakeholders, existing stakeholders, to explain the journey of this flip back, setting expectations right. A lot of times what we're seeing is bleeding time right now on some of these cap tables, is getting your smallest of shareholders to, of course, your larger shareholders, just align on what the process looks like and what you're going to need them to do to be able to come back. Because suddenly, regulatory compliances that were not relevant at Delaware or Singapore are now going to become relevant. So things like if you have, UBO declarations that go back to, say, Chinese ownership, things like that, irrelevant when you raised at Delaware. But this will need to be looked at. You will need to get ahead of structuring on things like that so that this goes through smoothly.
We're almost at the top of the hour, so just one last question. I always like peering into the minds of investors on one question, and maybe we can start, Akshat, with you. One business which you wish founders were building right now and you see as a white space and you're like, this is so obvious. Why are people not building around it? Anything?
I'll answer it more from a personal front because as late stage investors, we don't spend a lot of time thinking about new business models. We just wait for business models to come up, prove themselves, and then we go back them. But I love playing sport, and I'm a big fan of sport in general. I'd love to see a lot more businesses come up that develop good business models around sport, that make money and at the same time promote a culture of sport in our country, whether it's for young kids or old adults like us. I would love to see those businesses come up.
Arpit?
I like to believe that anything that has an opportunity is already being built. We just haven't found that entrepreneur yet. If no business is serving an opportunity, I guess the opportunity does not exist. So I firmly believe in the power of entrepreneurship, from the chaiwala all the way to unicorns. I don't think there is an opportunity which is imaginary, possibly, which is why there is no business being built right now.
But anything, anything which you feel people aren't doing enough of. Like the minister, famously said that not enough deep tech is happening, but...
Minister is obviously not well informed, as many of us, most of us know. I'll come back after Sumit. Let me think.
Sumit?
Yeah, I mean, Arpit's camp, we think all types of business getting built in India. There's massive amount of funding, so you can imagine all types of ideas are there. But if I were a senior executive in an IT services company today, and the kind of disruption that Gen AI is causing in that industry, I should step out and start something focused on AI-led IT services. And no panel goes without mention of AI, so you have to, I had to mention it. But there's a massive opportunity there to disrupt the entire industry. These are multiple...
Roughly 900 billion up for disruption, right, Akshat?
Exactly. So,
huge.
I would turn an entrepreneur today to see what I can do to capitalize on that. Because if you are a large ship, it's very tough to cannibalize yourself and pivot. But if you can start off scratch, and there are companies building around that, and unfortunately, VC is already there and overvaluing them at day one, but it's okay.
Nidhi, wear your user
Yeah.
angel investor hat.
Yeah, and I think it would have to be, for me, tech-enabled, affordable and accessible healthcare for non-tier 1 cities.
Eklavya?
So I would say a little more like precise engineering and traditional manufacturing sectors. I think India still is way behind, and I think a lot of opportunities can come that way, just learning from the West in that direction.
Excellent. Do we have time for 1 or 2 questions? Pawan? Okay. 2 questions? Okay. 1 question, okay. I've been told we can just take 1 question, so fastest hands up. Okay. Last row, I spotted you. Can we get a mic there, please? Or you can just walk up and I'll repeat your question. We have one mic only. This definitely needs AI tech to point out the person in the dark hall who raised there.
Hi. You know, I heard a lot of perspectives on the medium to the late stage when it comes to technology investments. Just wanted to ask from the early stage here. Not speaking about India's digital public infrastructure would be amiss. Just wanted to ask, how would you as investors be evaluating businesses that build on top of government platforms? UPI apps, ONDC, margins are thin, government mandates, there's the deplatforming risk that extends there. Just wanted to understand your perspectives on that.
See, unfortunately, these platforms are very democratic in nature. It is very hard to imagine someone being able to build a significant moat around them. If I was to build around ONDC, I can only build a limited amount of moat because anyone else can also build it. Hence, it becomes hard to justify why will someone fund you versus anyone else. Other challenge is regulation because every one of these come with strict amount of what you can do and cannot do, and navigating that ecosystem can become harder. However, obviously there are large companies like PhonePe have been built on UPI platform, Paytm is running on UPI, and so on. So more and more businesses will be built on this. Just that, and like a company called Digio runs on eKYC Aadhaar. A lot of good things have been happening and venture funded too. It's just very hard to imagine saying that you will be better than others unless you have proven some degree of scale.
Thank you very much. We just had time for one question. And thank you very much, investors. Really nice hearing your thoughts on how to invest. There are what kind of demands and opportunities are there. A lot of founders out there. Please go out, meet them. They're looking for your money. Apart from AI, deep tech, I think there is also demand for climate. And yeah, so I would just like to add to that. Thank you very much, everyone. So I'll request Apurva. Yeah, we'll take a photo and then we will ask you, Apurva, to